This video looks at accounting for supplies. Supplies are usually bought in bulk. So whenever a company buys supplies, these are treated as assets because they're going to buy a lot more supplies than they are going to use during that period. When supplies are used up, they become an expense. Supplies are an example of a deferral. Remember, deferral is when a company pays for the expense before they use it up. When we say supplies, they're typically things that the company uses to do their day-to-day operations. So paper, pen, cartridges, and so on. Supplies pose a problem. Every time companies use supplies, they do not keep track of the supplies used. Just because it would be cost prohibitive to keep track of every time somebody goes to the supplies area and picks up a pen, they're not going to make that record in the books of accounting. It just does not make sense. But when supplies are used up, they are an expense, so companies do have to record supplies expenses. In order to figure out how much supplies are used, which is a supplies expense, companies take a physical count of supplies at the end of the period. Now they know how much supplies were available because they know how much they bought and how much they had in their stock. After the physical count, they know how much supplies are remaining in their inventory. So to figure out how much supplies were used, they take the supplies available and subtract supplies remaining to determine supplies used. Supplies used is the supplies expense, and this is recorded as an end-of-period adjustment. This slide helps you calculate the supplies used. So to do the calculation, you're going to start with the beginning balance of supplies. If the company had any supplies remaining at the end of the previous year, that becomes the beginning balance of supplies in the current year. To that, they would add any purchase of supplies that they've done during the year. That gives them a number called supplies available for use. So these are the supplies available for use during the year. To calculate supplies available for use, you take your beginning balance of supplies and add purchases of supplies. Then, after the physical count, they know exactly how much supplies they have remaining. So they subtract the ending balance, and that tells you exactly how much supplies were used during the period. Let's take a look at an example. This says a BC company had the following events for its first year of operations. Only selected events are shown. 1. Purchased $3,000 of supplies on account. 2. A physical count was taken and ABC determined that they have $750 of supplies on hand at December 31, year 1. And then at that time, ABC recognizes the supplies expense. They want you to use the horizontal financial statements model to show how each event affects the balance sheet, income statement, and the statement of cash flows. Before we go and do that, let's first determine what is our supplies expense. That is for part 2. That way we can just, once we know the numbers, we can just record everything in the horizontal financial model. Here is your calculation. So here's your guidelines for calculating your supplies used. And let's go ahead and use that framework to determine supplies used. First, beginning balance of supplies. This is the first year of operation. So if it's the first year, we know that the beginning supplies are 0 because they just started the company on the first of the year or whatever part of the year, but they did not have any beginning supplies. So that's 0. If this is an ongoing company and it's the second or third, they will probably have a balance of supplies in the beginning. Now, next one is to look for purchases of supplies. Did they buy any supplies during the year? Yes, they did. It tells us that they bought $3,000 of supplies. So we're going to put that 3,000 as a positive number. We purchased supplies. You add these two numbers, that gives you how much supplies were available for use during the year. That's $3,000 of supplies. Now we subtract the ending balance of supplies to determine supplies used. Did they tell us how much is the ending balance? Yes, they did. They said a physical count was taken and they determined that they have $750 of supplies at the end. So $750 gets subtracted. And that tells us how much supplies were used. 3,000 minus 750 gives you 2,250. 2,250 is the supplies expense. So we calculated this dollar amount to be $2,250. Now let's go ahead and see how each of these transactions affect the financial statements. The first one, it says purchase $3,000 of supplies on account. How does this affect the balance sheet? We know that we bought supplies, so we will have an asset called supplies. Under asset, I'll just put supplies in the first column since we're only looking at selected transactions. For transaction 1, our supplies increased by 3,000, so I'm going to put that as a positive number. What else happened? We purchased supplies on account. We didn't pay cash, we purchased on account. So now we have a debt. A debt is a liability, and when we purchase on account, we have an account called accounts payable. So accounts payable increases by 3,000. Assets increase by 3,000, liabilities increase by 3,000. That's all that happened in the balance sheet. Now let's look at the income statement. Is the income statement affected by this transaction? No, because we did not have any revenues or expenses. The income statement is only affected by revenues and expenses. Supplies will become an expense when they're used, but they're not used. We just purchased them. So therefore, the income statement is not affected by this transaction. Is the statement of cash flows affected? No, because no cash was involved in this transaction. If cash was involved, yes, then the statement of cash flow is affected, but no cash, the statement of cash flows is not affected. We're done with transaction 1. Now let's look at transaction 2, which is the expense. So what happened in transaction 2? In transaction 2, our supplies used up increased. So we've determined that our supplies used up was 2,250. That's a supplies expense. So we know that expenses have the effect of decreasing retained earnings. Retained earnings is a stockholder equity item, so I'm going to stockholder equity and say retained earnings. And retained earnings decreased because supplies increased. Supplies has the effect of decreasing retained earnings, so 2,250 decrease under stockholders' equity. Next, what else happened in the balance sheet? Well, if we used $2,250 of supplies, our supplies account would have decreased by that amount. So I'm going to decrease supplies by 2,250. I should have done this in Excel because then it would automatically adjust the totals. If you did it using Excel, you'll see that the remaining ending balance of supplies is 750, which is what they told us in the question. That takes care of the balance sheet for that transaction. Now let's see. Did this transaction affect the income statement? Yes, it did. We said we had an expense. Our expenses increased by 2,250, which causes net income to decrease by 2,250. Some students had a question, why does net income decrease? Well, for this transaction, revenue didn't change, so revenue had no change, and expenses increased by 2,250, so 0 minus 2,250 is a negative 2,250. That's why we always decrease net income every time expenses increase. We just don't show the revenue 0 all the time. All right, that takes care of the income statement. How about the statement of cash flows? Is that affected by this transaction? No, it is not. There was no cash involved, therefore the statement of cash flows is not affected. That's it for this video. Please let me know if you have any questions.